This podcast is produced by Linear B Group, the brand, content, and account-based marketing agency for the private capital industry. You're listening to Fund Shack. I'm Ross Butler, and today I'm speaking with Patrick Turner, Managing Director at VSS, a US-based lower mid-market private equity firm founded in 1981. Patrick joined VSS in 2014 after an investment career spanning private credit and leveraged buyouts in the US, and also private equity in China. Patrick, welcome to Fund Shack. The first thing I've noticed, being very perceptive, is that you're not American.
Well, that's the funny thing. I was going to come and say, actually, I'm just pretending to be English. But actually, I am really English. I grew up in England. And then at age 21, decided that US was an interesting place to go. I was lucky enough to get a job with a bank called Bankers Trust. And so took off and I had a one-way ticket. And so I've been there since, working in the private equity field, initially with Barclays, and then on my own in terms of our own fund, and then selling to TCW and now working with VSS. So it's been very interesting and fun, and of course America's been fascinating from so many different angles.
So almost all of your working career, and yet you've kept the accent.
Because I work with, at Barclays, my friend there, Nick Dunphy, and colleague, he and I spun off and raised our own fund together. He's English, and so we were able to sort of keep ourselves in trim.
Right, yeah. So the classic Englishman in New York.
Yes.
Does it help being English?
It does and it doesn't. I mean, I think the general perception is, which is completely false, is that your IQ is 10 points higher than it is, really, because you're speaking in this, very proper manner. But I think it's a bit challenging for we back founders in their businesses and we're helping them grow. I sometimes think perhaps being English, I'm not American. They think, well, he's not American, even though I lived there 40 years. I understand completely how things are done there, but there's that little mismatch. But I think generally, yes, it's been, listen, I've had loads of fun and business has been super. I think being in England might have been even easier, actually, but, from a professional standpoint, but it wasn't, so.
Yeah. So mid-markets are interesting because, in the venture capital world, it's global, and in the large cap world, that's more international and global, but mid-markets tend to be very domestic, and I'm very familiar with the UK one and France and Germany to an extent. The US mid-market is different. It must be huge. I'm really interested in kind of how you prosecute it from just a geographic perspective. How do you slice and dice the market? Is it the whole of the US that you look at?
So there are somewhere around 150,000 companies in the US in the middle market. No one has a particularly firm number on it. Could be more. And obviously of different sizes. What is the middle market? Lots of people have different views. I say it's 100 million in revenues and below, but it's actually typically considered to be 500 million in revenues and below. The country is going through various changes, as you know. I mean, from when I was there in 81, it was more a manufacturing-oriented country, and now it's a service-oriented country, as we all know. And there are pockets of growth, with tech, for instance, being Silicon Valley and California, perhaps in Seattle, and Boston, and then still the engines of traditional American industry are in the Chicago sort of Midwest area, still are actually. But the real growth is down south, where you've probably seen a whole bunch of people leaving New York for tax reasons and other reasons as well, personal safety reasons and so on and so forth. And of course, the growth is in the south. So we do invest everywhere in the States, but I would say most of it, we like the Midwest. Definitely the characteristics of the founders typically we back are very solid, very hardworking, so on and so forth, very reliable. So that's always been a good area for us over time. But also we invest in California and in Florida and Oklahoma.
So how do you narrow down your funnel then? Because that's a large universe, presumably.
We have 3 verticals we invest in, and so it's about the verticals. And the verticals are education, healthcare, and outsourced business services with a technology angle. So that narrows your field about what you're going after. So no manufacturing, for instance, no distribution, for instance.
So when I was a reporter writing about these markets, I was aware of Veronis Suhler Stevenson, yes. Which was, I think, what it was previously called as a kind of the top media investor. Now, you obviously pivoted away from that. Was that before you joined or during or after?
It was before, and this is very interesting. You should raise it because people still remember the Veronis Suhler Stevenson and the book they would put together about the media industry. I don't remember if you remember that. Yes. It was the Bible. And they lived on it for years, and they were the first firm that were focused just on media that was created back in the early 80s. And so unique. Now, of course, so many people are doing media or various variations of media. And so TMT, they call it, And so they did very well for 81 until early 2000s. Then you had the internet change, but you also had a lot of consolidation in the market. If you think about all the cable stations and TV stations and radio stations and magazines, etc. But the most important was the internet effect on advertising in particular. Yeah. And so traditional media became sort of definitely a bit of a relic. And that's when Jeff Stevenson, which is the S, the other two, by the way, have left a long time ago, which I'll come back to. Jeff pivoted in 2005 to what we do today, which is structured capital, not buyouts, so much more minority interest as well as some majority interest in smaller businesses. Typically, the VSS media businesses were 50 million in EBITDA. We're looking at 5 million in EBITDA, so very different markets. And the pivot was sort of very interesting. His what he likes to say is Reuters was bought by a large Canadian publishing company, newspaper company, and you didn't really hear about Reuters in those days. Now it's just Reuters, and there's no longer the
is it Thomson? Or?
Thomson, exactly.
Yeah.
And so Thomson, you don't hear about really anymore. You hear about Reuters. So we made that pivot away from sort of traditional media to tech-enabled, which is what Reuters is, sort of business-oriented, business technology, which I think really helps outsourcing, is reducing costs, of course. And then the education and healthcare comes along with Reuters as well, funnily enough, in certain angles. So he sort of made that switch and at the right time.
Yeah. That was always where the money was, I suppose, with the media industry. It was kind of the offshoots. It was the data.
That's it.
Or it was,
Well, it is now, isn't it?
Yeah, it still is now,
with,
of course.
of course.
Yeah, and so that's where you built your expertise.
Yes.
And then you came on shortly after that. What had you been doing just prior to that made you kind of suitable?
So I'd worked at TCW Crescent, which is the alternatives arm of TCW. TCW is a very large multi-asset manager based in Los Angeles. And we were the subsect doing non-traditional investments. And I ran the New York office for them. I sold Canterbury to them, in 2005, in order for them to create the New York office. And so I ran the office for them. And then after 8 years, Jeff signaled, perhaps you should come give me a hand. And so I did. And that's what we did. And so, the other thing I was going to say was Veronis Suhler. Unfortunately, Veronis died, I think, a couple of years ago and had retired back in 2008, 2009. And so when he and Suhler, who were both time execs, left the firm, that allowed us to get away fully from media. So if you looked at our funds, our Fund 1 still had a fair amount of media, our Fund 2 had none. Right. So that's the way to think about it. It's sort of very interesting. And so a full pivot was made, I think partly because they left. I got these stats I came out with. The market was about half the level of it was in 23 versus 22. And in terms of volume, and most of that volume was add-on acquisitions, 75%. So if you think about new platforms, how few were created, and that's really because of the debt markets fell apart with Silicon Valley Bank back in, I think, April, and took a while to come back in terms of confidence. Towards the end of the year, there was, again, money available for larger buyouts, so several billion, for instance, in leverage, which there had not been. And so that allowed those buyouts to happen. So I think it's picked up a bit, but it's not picked up nearly as much as I think people hoped, partly because of expectations of value on the sales side. It's been a relatively low growth revenue over the last couple of years. And as I mentioned earlier, inflation as well, particularly at the employee level. So trying to get that number that you've got in your head that you want to get for your company, perhaps there's a mismatch between expectations or valuations. And so people haven't really sold unless they're very, very good companies. Right. So very interesting. Middle market, of course, you haven't been so reliant on debt, so it's tended to held up better.
Yes.
Interesting.
So what about exit markets?
It depends on how you look at it.
Yeah.
I think on enterprise value, for instance, I think it's 200 basis points less. So if it was 12 times, it's now 10 times, 14, 12, etc. The very good companies are still going for high multiples. The medium companies are not going at all.
Right.
Interesting.
Yeah.
Again, I think it's because lower growth, if you model your returns with very, much lower leverage, because you can't really put a lot of leverage on them these days with the cost of capital.
Yes, yeah.
That you'll find that's why the activity is being so much lower. But on the other hand, you've still got 2 trillion of private equity powder out there, and some say 3 trillion, by the way. So there's a lot of money on the sidelines of funds that have been raised, some very large ones, of course, as you probably know, but a consistent level of both debt and equity being raised that's on the sidelines wanting to play. And so I think you all will start seeing probably those expectations come down a bit and therefore more transactions.
Yes, yeah. VSS only provides equity, is that correct?
No, we provide what's called structured capital. So it can be debt, it can be preferred, it can be equity. It's just whatever the founder is really looking for to achieve his goals. Our pitch really is we like to combine a current yield with an equity position, which allows us to be more competitive in growth capital.
Ah, yes. From a founder's perspective, is that?
Yes, yes, exactly. So, for instance, a competitor of ours would be doing growth capital, let's just say pure equity or preferred. Their expectations for return would be purely in that instrument. If we get, say, 10% yield on one of our instruments, then maybe half of that is in yield and half is in equity, so we can be less dilutive.
Right. Let's say the downside from a control freak group perspective is that you're not in control.
Yes.
How does that work?
Well, they're still in control from generally majority owners, but we have so many rights, and of course we have covenants on the debt. So what's really good is the owner has to be very, very sure about where he's going or where she's going in order to take on that debt. Why would you take on debt if you weren't certain? Yeah. So in a way, you're sort of
self-selecting.
It's self-selecting, exactly, and that's why I think I like so much where we are. And then under 10 million of EBITDA is really a relatively untapped, so not totally untapped, but market where banks, for instance, can't go anywhere less than 15 million at least of EBITDA. And then BDCs are required to have income in terms of their securities has to be mostly in income. So we have a lot more flexibility.
Right.
And so we happen to have that little niche. There are others who do it, but not many.
And how does the kind of corporate finance deal flow market work for your part of the market in the US?
It's changed so much over time, and obviously I've been doing it for a while, so I've seen this. But there only used to be a handful of investment banks or brokers, etc. Now there are hundreds. So we have a BD team that taps out, and they told me they have 600 relationships in terms of boutique investment banks that are selling on behalf of owners or finding capital on behalf of owners. Pretty interesting, very different from. When I
600 intermediaries before you even get to the companies themselves. Right? Yes. So, okay, that's hard work. And so, in terms of so you've got three sectors that you focus on. What's looking particularly promising in, or are there any meta themes like technological disruption that you're playing into within those three things?
Well, AI, of course, is the big names these days you have to think about every time you're making an investment is how it might affect you. And obviously, if you think it's going to put you out of business, you're not going to do the deal. But it's a very interesting time for investors. I tend to think it actually helps in most cases. It's a help, not a hindrance. So it helps reduce your costs. It makes you more efficient. Your technology can be improved significantly, for instance, and may not completely disrupt you. So those are the situations which are obviously the best. And I like outsourced businesses today versus healthcare and education. Education, a fair amount of money is being plowed in by the American government, which I think is going to stop. So you wonder how that's going to affect it. Two, not that education doesn't need a lot of help, because it does. You've seen the stats about where Americans stack up. But harder to find deals that really match your focus points. And then two, healthcare services, I think that's where you've seen the most inflation from an employee standpoint. And so if there's no top line growth, you're going to have a real compression of margins. We haven't really seen it terribly, but because we're not levered, it doesn't really have so much an impact. But you really do need to push up prices. They tend to lag. Insurance proceeds tend to have some effect as well, those type of things. So we're a bit shy on the healthcare services at the moment.
Right.
We just did one about a year ago that's doing well, but it was structured in a way that really helps to make it. So what happened is a plastic surgery roll up with three very, very high end docs, and they contributed their business to the overall company, and then we contributed considerable capital for the growth. So that's a different perspective of how to structure things, really enabled, I think, for a successful story.
Yeah. But so you think that outsourced business services, that's the area?
Yes. And it's a vast industry. It's probably a third of the market. And obviously everyone's looking to reduce costs because there's the other personnel costs continue to increase. Your input costs continue to increase. So yes, you can probably push through some price increases, but more and more difficult these days from a competitive standpoint. So it's really about how do you reduce your costs. Yes. So one of our deals that we sold recently was a finance and accounting firm that really had a very efficient, cost-efficient technology that you as a small business could use their technology, very accurate. The inputs were made in India, and so very cost-efficient. So you could sell it for $500, $600 a month to a small business to do their accounting, which is very effective compared to hiring an accountant for, say, $25,000, for instance. And so that was a very, very perfect example, and I think the opportunity in that company is still enormous.
Yes. In terms of how you work, like so you've invested in a company, you've sold to the founder, and now you're in bed together, as it were. The value creation process from your perspective, how does it typically look?
Super question, and I think that's sort of the difference between us and traditional, what we call credit providers that really don't have those skill sets to help transform these companies. So what we're trying to do is institutionalize them from really founder-owned, very much back of the seat accounting would be QuickBooks, probably a controller, maybe an outsourced accountant, really turn it into a real firm with real structure, good finance controls, good otherwise controls, metrics that we measure, KPIs and so on. There's a 90-day plan, so that's what you'll hear from lots of people. We put a 90-day, maybe a 100-day plan together that gives a roadmap for these founders who really have had no input from people such as us, who can really help them organize themselves better, organize their businesses better, organize their people better, have real standards that people should account for, as well as profit plans, for instance, where everyone can participate depending on how well the company does.
Yes.
So it's very active. We're on all the boards. We have a lot of rights, but we're very active in trying to be constructive. And again, I think it comes down to the whole sort of courting process with the founder to be on the same wavelength. When you actually go and give them the money, you sign the dotted line, you need to be on the same page. And you can give them a good map about where you think it should go, and they'll have input, of course. But they're very grateful for the help that they can to, as I say, once you institutionalize the company, you probably change the value of the company too.
Yes. And how often does good corporate best practice change and evolve? Because you're seeing it across lots of companies. Is it like once you know it, you more or less know it, or how rapidly there's this new way of doing things that you need to then spread across the portfolio? Do you know what I mean?
I do, and there is some consistency across the board with all the different companies. There are things that you do in every single one. So that roadmap, as I say, everyone says, "What's your roadmap?" Well, there's certain things on the roadmap which everyone has, like for instance, the financial controls, which are so important. The KPIs are so important to understand where things aren't going right, where things are going wrong. Costs, of course. Full evaluation of costs, some whiteboarding that goes on as well. What can we do different? Which is super. They would never, when you're in there as an owner, you've been doing it for 5 to 10 years. You haven't really thought about that. You've been plodding away, just growing the business naturally. Now you think about, okay, what else can we do? Can we make an acquisition? Can we hire some people and change the verticals that we're focused in on? Things like that. And so what we have is really, we tend to invest, call it 25 million-ish day one, and then we'll have some reserve to allow them to make acquisitions. And so the idea is to buy down the valuation, of course, and create more scale, probably more organic growth. And so eventually get these companies from 5 million EBITDA, let's just say, to 15, maybe 20. And then you're talking about a different universe who are going to buy them.
And how often can the same founder and CEO keep going when you're doing these rapid roll-ups?
You really need to have a good infrastructure in place to be able to do it, so that they're not distracted by that. You're helping them do that. They obviously have to have a good finance team to be able to affect that. And then harder than people think. They're saying, "Oh, very easy. Let's just merge these two companies together." Well, there's a lot that it needs to be thought through. If you saw, I'd show you a list of things that we did when we just made an acquisition. It's 2 pages. Intense work. Mostly on the finance side, but also just from a reporting side or personnel side, and people need to buy in on it. It's really complicated. It's a lot harder than
No, it doesn't sound easy to me at all. I mean, growing rapidly organically is one thing, but growing via acquisition when everything's being constantly transformed, that sounds like a headache.
It's fascinating.
Yes, that's a better way of putting it.
Well, I'll tell you a very interesting situation right now, which I'm on a company called Globo Translation. Provides translation services to doctors and hospitals mainly, which are, of course, it's critical because you need to be 100% certain. And of course, they have every language. Most of them, by the way, in the States, it's Spanish if it's not American, as you'd imagine. In any case, it's a fascinating company because we made 2 small acquisitions, and started off at the same number I mentioned earlier in terms of roughly where we are. But we've also introduced and spent money on a pretty powerful internal sales force. So the organic growth is tremendous on top of the acquisition. Can you imagine how complicated that is? And onboarding these new clients, and it's all technologically driven. It's just quite remarkable how good I think this management team is. But that's exactly what you're saying. But it's fascinating.
Yes.
So you're seeing all these things move at the same time. Sometimes, of course, they're bumps, but generally, the end game is a good one.
Yeah, I'm sure. This is changing tack slightly, but I noticed in your bio that you've worked in China in private equity. How does that period of your life, if at all, play into what you're doing now? Does that experience lend any kind of quality of use in the mid-market?
So what happened was when I left TCW, you're put on what they call gardening leave. You have a non-compete for a year. So I'd been involved in a private equity fund in China called Crimson Capital with a friend of mine called Mark McCall for quite some time, and we'd made a really good investment in a casino, and we'd done really well. And so I thought, well, let's use this year cleverly and find out about this emerging market called China. And so this was in 2012. So, still relatively early days. I know not really early, but early enough, and where people were starting to invest foreign monies into China. And it was learning about what the rules were and how to do this and where you might find a position to do something. And we came up with doing retirement homes, because retirement homes early on were owned by the government and were not exactly where you'd want your mother to go. So this was the idea, but we really couldn't, and we had land we lined up, but we couldn't find the investors to support it. And I'm actually glad we didn't. Yeah. Because you had COVID, would have been a disaster.
It would have been a nightmare. Yeah.
But it was fascinating, again, as you say. And what did I learn? So many different things, nothing particularly that would translate other than, like everybody and you can say they're a developed country, you can argue that, is they're still going through so much change that, and you see the desire to reduce costs, for instance, efficiencies and so on and so forth, that really do translate.
So believe it or not, we do have quite a few younger viewers, and hence the next question,
really?
Which is, particularly on like YouTube, which is, do you have any kind of advice for people that are interested, not only in getting into private equity, but getting into like the lower mid-market, partnering with companies and that kind of thing? What kind of person does it take, and what kind of experience is useful?
Private equity, for whatever reason, has become the sort of sexy place to people want to go, particularly who've gone to business school and who are in the business mode, rather than, say, wealth manager, for instance, or working at a bank, for instance, lending money. And so, and of course, the economics are very, very favorable. Tremendous place to learn. You've got really, really good people running these firms. So really, you learn, like one of my friends who work with me, a guy from Georgetown, said to me he's been drinking from a hose pipe since he joined 2.5 years ago. Right. So I think that's brilliant if you can get in, and the learning that goes on is so incredible, because you're really getting into the weeds of these lower middle market companies, more risk, more vulnerable, certainly don't have the control systems that the large companies have and never have. But by the way, forget about even controls like governance. They haven't had those. So from just a learning perspective, how companies work, what makes them tick, what makes them make money, what makes them risky, what are the things that you might run into that would be detrimental to your investment. Those are the things that are just, to me, are basic, but are basic to the economy, aren't they, to every single business. So private equity is a perfect place for someone to learn that and to grow. And there's so many elements of private equity in terms of, you do have investors on the other side that you've got to look after. They are essentially, you're responsible to them, and you have to perform. If you don't perform in the top quartile, you're not going to raise another fund. So there's all these elements here which are, I think, good if you're competitive. To get in, it's really hard. I think you really need to go and sort of what they say, join a bank or some sort of large financial intermediary where you get the basic skills of Excel, learning how to present pitch books and that type of thing, and that gets you now in the mode where you're very useful to us, where we can have a deal, I give it to you, you'll just run the numbers quickly, you'll make an analysis of risks and pros and cons, and then we both chat about it and decide whether we want to move and what type of structure we'd like, and then try and arrange a meeting with management and see if we can come to agreement, and also through an intermediary, as I said earlier. So that's the way to get in. I think it's very hard to get in if you're not a finance major.
Right.
I'm not. I'm a languages major, but I went to a bank first, as you know, for 9 years. So I had that training of lending to small businesses, which then translates to what we do today.
So you got the finance major, and that's like the table stakes at least. What turns you from like a promising private equity intern or whatever to a genuinely top deal maker? What's the qualities that are required?
It's such a good question, because you see people with so many different personalities, don't you, if you're in any business? So you'll have a person, for instance, who's unbelievable about pulling apart numbers or understanding how the business is run, and just sort of geniuses in terms of math and things like that, which are very useful, but they'll never probably progress because they don't have the personal skills. So I think there's an element of burnout too. In the early years, you've got to be prepared to put in your years. But again, I think it's so lucrative potentially. And by the way, coming out of school, if you get a job at a private equity firm, you're making pretty good money. But I think it's the qualities of having both the qualitative and quantitative.
Right.
So if you're a person who can relate to people, you can understand how their businesses are, you can understand what they want. All these things that are wholly part of it, to convince them that you're the partner that you should go with. That takes years and years and years and years.
Yeah.
It's just not something they're not going to trust your entire company with somebody who really hasn't had much experience.
Yeah.
And so this one deal I did called Olympus, which was the plastic surgery deal, they interviewed 19 private equity firms. And finally chose us because of some of the skill sets we already had done with some other firms.
Yeah, so at that level, it's not they're not just looking for the best price, they're looking for the best.
That's right. I mean, you have to be within a reason.
Of course.
But you're absolutely right. It's never when you're at the larger PE firms, I actually think it is all about price. When you're selling, it's all about what's my maximum price. I don't really care who I'm selling to. It's the maximum price. When you're a founder, there's so many more elements that will help save your business, make it grow, make it very, very, very valuable, or not. And so it's a different mindset. So the price isn't necessarily the key. A couple of percentage points of equity is not going to make a difference.
Yeah. So I don't force my guests to prognosticate too much, but do you have any thoughts either on, the prospects for the next vintage of investments, or indeed for, VSS and its next kind of phase of growth or development?
All firms like to diversify and grow their firms through different strategies as well. We will not. I mean, I don't think we will be. We like what we do. We like where we play. This sort of lower middle market is, I mean, I don't know if you've seen this, but there's the stats on new filing on corporations every year is significant of new business that are being created in the States. That's what's so interesting. They say 70% of all jobs created are by new businesses. So a remarkable number. So I think it's a great place to be, and I like what we do, and I like why we do it, and I think we get better all the time. I think playbook wise, and where the mistakes you've learned, often the mistakes are execution oriented. That tends to be the case. In terms of where should you invest as a person, if you have access to private equity, I still think it's a very important place, but I'm not so fond today of the larger PE firms. I think the use of leverage, which is typically 5 to 6 times EBITDA, at a 10% to 11% interest rate is formidable in terms of sucking out cash flow you could otherwise use to grow companies. So that's why we don't like to lever. So I'm not so fond of those. So there's been some big funds raised, massive. I just can't see how you can get the sort of traditional returns in those. I like secondaries in terms of institutions should invest in secondaries. I think there's still a supply-demand gap.
Yeah.
Like there's not enough money in the market. And a ton of people are looking for liquidity all the time. Last year, there were very few companies being sold. So a lot of institutions who need to pay out, you can imagine, look to sell their portfolios. And so the secondary market's been very active and I think, very attractive too, because I think they're buying it below par.
Yeah.
So somewhat, not huge, but so I like that area for investors in our market. I like the lower middle market. I think you'll see a lot of institutions are going towards credit, because credit yields now are so high compared to the past that a 10 to 11% return is very attractive to their institutional base. So, for instance, the big public pension funds, if they can do 11%, 10%, 11%, it's above their hurdles.
So it's the things around the periphery of big buyouts that are still attractive, but not necessarily the the buyouts themselves.
A lot of people have gone into credit for whatever reason over the years, maybe because they just saw the basket for PE being so small, so they were just going to go for the swing for the fences, which is what you'll hear. But the credit thing has really taken off a lot because the default rates are actually relatively attractive. My view about senior debt on large buyouts is if they're structured properly, very, very low likelihood of losing money if you can wait long enough. So you might go through some cycles, economic cycles, but if you hold long enough, that's been my experience anyway.
Yeah.
So I think, it's now you'll see it's taking root all over the world now, credit. It's become a staple of a lot of the big funds where it was not, say 10 years ago. Private equity swing for the fences, we're going to get great returns, but it's only going to be a small portion.
Yeah. And is it a cyclical trend? Will interest rates hit rock bottom again? Will it become less attractive and go back to where it was? Or
No, I think that's right. I mean, that would suggest, if that's the case, that of course inflation's under control, which is good, very good for our businesses. I think that there are other headwinds like COVID, for instance, that happen. They're out of the completely out of the blue. You can't factor in, but you have to think about those potentially coming in. And what happened during COVID was a lot of the private equity funds really protected their assets by putting in more equity, and so were able to ride the storm. And plus, there was some fair amount of government help, as you know. So, but I do think you need to be thinking about cyclicality within the business itself that you've invested in. But I think there's probably cyclicality, as you say, in investing. For instance, distressed used to be, a hot topic. People like to invest in distressed funds where you buy a company that's filed for bankruptcy and you take over the company, you fix this, that, and the other. Well, that's been a terrible market for the last 10 years.
Yes.
Maybe it'll be okay this next few years. We'll see.
Yeah.
But interesting. So there are cycles.
Nothing's good forever, and everything comes around eventually.
Well, exactly. And I also liked lending for venture capital firms.
Oh, yeah.
You get a fair amount of equity associated, warrants and so on. And I always thought that was a very interesting play, particularly if there was value in their company. So not too early, but had got to a certain level. And I still do like that space. And the players in there have shrunk. So Silicon Valley Bank was a big investor in that space, of course. Yeah,
we just had a lady in here actually from a company called Bootstrap Europe that bought the German portfolio of Silicon Valley Bank. And I hadn't thought about venture debt as a kind of an asset class before, but I think you're absolutely right. It sounds very attractive.
Yes, I like it. I like it. And then there's sort of niches. I think there's always niches of some sort. I mean, for instance, there was a record. There was raising funds to buy the rights to records and so on, which I think has been quite popular. It's done actually quite well, I think. Same with lumber, for instance, but it's also cyclical because of the end markets. And so there's always these things that come up, come down. But I think overall, PE is here to stay, but it's about alpha. It's no longer about beta. That's the thing I think you've got to think about. And I went to see one of our investors and he said, well, there is no alpha in the high buyouts, and it's much more beta, which I think is probably true. Though managers make a huge difference. If you get a good manager in a big company and it's still a large company, you can do very well. Very well.
Yeah. Great. Well, thank you so much for coming in and sparing your thoughts on VSS. Best of luck for the future.
Thanks, Russ. Great to see you.
You've been listening to the Fund Shack podcast. If you like what you've heard, click follow on whichever platform you're listening or watching on, and visit us directly at fund-shack.com. It's got a treasure trove of private capital insights. Thanks for listening.